This is Urshel Metcalf with Vortex Banking from Epic Optimized. And I'm glad that you're here. We're going to present to you the concept of Vortex Banking that we used. And we share this with individuals so that you can see the outcomes of what happens when you change the economic flow of how money moves through your economy, whether it's business or personal economies. And we're doing this in conjunction with Clear Metal Crypto and my good friend Ryan Bitters, who's probably invited you to view this webinar. And so we'll talk specifically on some things that may be of concern specifically to you, but also introducing you to the concept, because although we're not sharing with you anything that's new or anything that's revolutionary, we're sharing with you some very well time-tested tools that are older than all of us, that have been used for a long time. And we're combining two of those tools to create a tremendous impact that we call Vortex Banking. And ultimately, it's creating an indestructible financial system that allows you to have wealth engines that will create legacy. And once your money goes into your Vortex banking system, it will never leave, and it will only multiply as time goes by. And so I think that we'll make this very clear for you. And then obviously, if you have any questions, you can reach out to us, reach out to Ryan at Clear Metal Crypto. He can connect you with us, and we'll be glad to do a more personal individual presentation and show you how you can put these things into effect in your economy. So these strategies for people who want to create generational wealth, protect their assets, secure their future, and ultimately keep more of the money that they make. Okay, and so we have a team. Our team now is probably about 15 to 20 people. These are a few of them. My name is Urshel Metcalf. I served 13 years in the Marine Corps, combat veteran. And 2009, after I spent some years doing missionary work in different places around the world, I came back home to Dallas. And that's when I started in financial services. And some of the concepts that I'm going to share with you today, I began to learn shortly after I started selling insurance and moved into wealth strategies. And then eventually I launched a private equity company where we raised about $14 million to invest in early revenue businesses. And since that time, I've been doing business growth consulting, focusing on economic efficiency for business owners. And that's what brings me here today. My company is Epic Optimized. I have Tony Hills. He is a national champion NFL player with the University of Texas, 2006, and drafted by the Pittsburgh Steelers after that, and won a Super Bowl the very next year. He had about 10-year career in the NFL, and now his focus is on these economic principles, especially for athletes and celebrities, because he's tired of seeing all the stories of people who get all of this money, they're young, and then they end up broke or getting scammed, and those sorts of things. So he's very passionate about that. We're lucky to have Rush Mars of Black Pearl Financial also with us. She's managed funds. She's focused on, oftentimes she's focused on female founders and helping them find funding. She has deployed hundreds of millions of dollars through Bank of America and Small Business Loan Association, things like that. So she definitely is a great asset to our team. And then also Paul Shaw from Apex Vision. He is an IRS enrolled agent. And so he works with our clients specifically on how we do both their taxing and operate within the tools that I'll be sharing with you today. Again, this is just a small portion of our team, but we have a lot of people working together, and I'm proud of the fact that we have a very diverse skill set with the people so that we can best serve all of the clients that we're speaking with. My mission has always been these three things: to educate, empower, and equip. And so every time that I'm in front of a group of people or an individual or a crowd, these are the three things that I'm trying to do. And it's what I'm going to share with you today as well. So we're going to jump right into it. I'm not going to waste any of your time. And I'm going to make sure that I give you good information. And again, you can hit us up if you have any questions after this, or we can move to the next steps. So here we go. This is the economic system, what you're looking at right now. This is the economic system that almost everybody in our country operates on. And it is a system of inputs and outputs. And this is may seem oversimplified, but in reality, this is what it boils down to. People have money that comes into their economy. Again, their personal economy, their business economy. That can be a paycheck, it can be a 1099, it can be however money comes into your world. Those are the inputs. And then basically, we have four categories of outputs. Now, we can get into a whole bunch of other things, but stay with me and you'll understand why we're using these four outputs, and we can fit just about everything in there. So, the first output is consumption. We pay bills, we buy clothes, we buy food to eat. Anything that we go and we just spend to get something, that is consumption. And so, again, nothing's bad about that. And that is a part of life, and it's something that we have to do. What we're going to talk about with all four of these is the economic impact of operating in this system and doing these things. So, the second way that we have money go into outputs is we borrow. Now, we borrow because we don't have enough money for what we'd like to purchase. Typically, like if we want to buy a house and we don't have the $600,000 cash, we take out a mortgage, we borrow. If we want to buy a car, typically we take out a loan and we borrow. So that's one of the other ways that money goes out, even though in practicality, that's money coming in, but it's also an output because you have to pay it back. The third thing is savings. So we take money and we save it. We're not living paycheck to paycheck, hopefully, and we're able to save some money based on what we're earning. And then finally, if we're doing well and we're a little bit savvy, then we invest. And there's obviously a lot of ways to invest. I know many of you watching this are investing in digital currencies. But you can invest in businesses, you can invest in real estate. There's so many different investments that you can make. But these are the four basic ways that money goes out once it comes into our economy. So let's talk about the economic impact of these four things in this input and output system. So the first thing, consumption. What happens when money comes in and then I go buy something? I go fill up the grocery cart with $250 worth of groceries. I, pay a bill, a light bill. I need a new shirt. I go buy a shirt. So what is the economic impact? When money comes in and I take my money and I consume with my money, what happens is the opportunity cost is huge. Here's the reason why. When I spend that money on something, I get what I paid for. I don't get robbed. I get what I paid for. But now I lose the ability to earn interest on that money for the rest of my life. It came into my economy, it did one thing, and then it went to go work for someone else. Now, when you think about that opportunity cost, if you're 20, 25, 30, 50, if that money that you used to buy that shirt or to pay for those groceries could be working for you for the rest of your life, then that's another 20, 30, 50, 60 years that the dollars that you spent today could still be working for you in your economy. But you lose that when you operate on the input output system and you consume. The second thing is borrowing. So, again, we say we borrow so that we can get something that we either don't have the cash or don't want to spend our cash to be able to use or to acquire. But when we borrow, the economic impact of that is now I'm obligating future dollars that I have not earned yet. I haven't traded my life for money in those circumstances. But when I do, and when I get paid the next time, and when I get paid the next time, I have to service debt from a previous obligation. So I'm obligating future dollars for something that I purchased in the past. So what does that do? Same opportunity cost loss as consumption, because those dollars come in and they immediately have to go somewhere else to service debt. And so in effect, I'm actually lowering the asset base that I have from income every time I acquire more debt, because that money is automatically taking away from my income because of the debt that I owe. That's the economic impact. Saving. This is the one that I think most people have totally upside down, but it's because of what we've been taught and how our system has been set up for us. When you take your money, you get paid, and let's say you save 18%, or you save 20% or 30%, whatever your savings is. If you take that and you put that in a bank, I don't care which bank, Chase Bank, PNC, whatever bank that you put it in, one, savers are losers right off the bat, based on the economy that we have ever since the 70s, really, and even before that. But when you put money in a bank and you put it in a savings account, I checked Bank Rate a week or two ago. The highest savings interest that I could find in a bank was 0.5%, and most were lower than that. So now when you take your money and you put it in a bank and it's in a savings account earning 0.5% or earning nothing, you're losing purchasing power every day. As a matter of fact, we are at a 40-year high right now in inflation. And so money that you put in the bank today, let's say you put $10,000 in the bank today, you come back 5 to 6 years from now, it still says $10,000 on your account because you haven't taken it out. But relative to the day that you put it in 6 years ago, you can only buy $5,000 worth of stuff. In 5 to 6 years, you lose half of your purchasing power because your money's sitting in the bank. But what's happening to that money while it's in the bank? Well, the bank is making a ton of money off your $10,000. We have fractional reserve banking, so they're only required to keep 10% of that on deposit. And then they take all of your money and they just make imaginary money, right? They can leverage out the dollar that you put in 10 times, maybe 20 times. And then they can give out loans for every dollar you put in, they can give out a loan for, 10 people and earn interest. So they take your dollar, turn it into $10, turn it into $20, and then they earn interest on those loans while you're losing purchasing power. Savers are losers when we do it based on the banking system and the way that we've all been taught to operate in this system. And finally, investing. When we invest, we hope to get a good return when we place our money somewhere else or into a different situation. But here's the thing. Here's the economic impact of investing. Now, again, obviously our money can appreciate, we can make money and get a return on investment. We can lose money and not get a return and lose our principal. So that's just the risk of investing. We all know that. But the economic impact of investing, whether you win or lose in that investment, is one, that money is illiquid to you while it's an investment, so it cannot work or do anything for you during that time. So if you're investing for 5 years, 10 years, or the long haul, again, that money has come in, it goes out into an investment, but it can't work for you now. And you have a hope and an expectation that when it comes back, it's going to come back with a greater amount of cash and it's going to have earned more money. So the money's illiquid, and then we also surrender control because we're typically not in control of how that investment, what results it brings to us economically. So we surrender control, and we can actually get a return, or we can lose everything. But we surrender control, and the money is illiquid to us, so that means we can't use it. That's the economic impact of these four things when we operate on the system that is really the system that we've all basically been taught as we grow up. But this is what we teach. And this is what I really want you to understand before we get into the tools that we're going to talk about and talk about some of the strategies. This is the most important thing that we're going to discuss in this webinar. And that is changing the economic flow of money through your economy. Again, personal or business economy. And this is something that we all should have been taught at least in middle school, if not definitely in high school, whatever economics class that you took or just basic finance. This should be something that we should all understand. And the principle is capitalization. So here's what we're going to do. So now we have inputs, the same inputs that we had before, however money is coming into our world. And so we're getting that paycheck, we're getting that 1099, we're getting those commissions, we're getting that inheritance, whatever it is. Money's coming into our system. Now, the first thing we do is we start the capitalization process. And what does that mean? When money comes under my control, when it comes into my economy, the first thing I want to do is I want to arrest that money and I want to put it into a financial vehicle that is going to begin earning me interest. What type of interest? Compound interest. How long do I want to earn that interest? For the rest of my life. So when we find a vehicle like that I'm going to show you, now we can take this and we have this financial foundational leverage that we have our money that comes in, it goes into our capitalization structure and it goes to work for us immediately and it never stops. Now, I said, what type of interest? Compounding interest. Albert Einstein said that compounding interest is the eighth wonder of the world. Those that understand it earn it. Those that don't pay it. And so we're going to teach you how to earn compounding interest on the money that comes into your economy. So now that this money comes in, I capture it, I put it into my capitalization strategy, and I put this money to work for me. And now, because I have the capitalization strategy, because I have the ability to do this now with this tool, instead of me spending my money to consume, instead of me servicing debt with the money that came in, instead of me taking my money and put it in a savings account and losing because inflation is beating my dollars up, and we're going to have inflation every year. That's something that's been forced upon us as we continue to print money. And also I have the opportunity to invest, but it's all different now because now I'm not sending my money out. Because I have this foundational leverage, that gives me the ability to collateralize. And so for round numbers, let's say I have $100,000 in my bank, $10,000, $1 million in my bank. Now I have dollar for dollar exactly that much collateral. So if I have $10,000 in my bank, I can now collateralize a loan for $10,000. And then that's other people's money. So now instead of paying my bills with my money, I'm deploying other people's capital to consume. I can actually borrow because of the collateral that I have. However much I have, I can borrow that much or any amount under that based on the collateral, the capitalization that I have. So that solves the borrowing problem. And because I'm the bank, I get to decide the terms of how and when I pay things back, if I do pay them back. And we'll talk about that a little bit more. What my savings is built in, because now that the money's coming in, not only is it locked in, but it's earning compounding interest for me. And we're going to show you how powerful that can be, even on a small scale. So the savings is built in. And now also when I invest, instead of investing my money, again, I have this collateral and I can take that money, other people's money, to go and invest in whatever endeavor I choose to. Just by adding this one thing into your economy, it will absolutely revolutionize not only your personal economic flow, not only will you get out of debt faster, not only will you build your retirement faster, but you will pay less in third-party interest while at the same time earning interest on the money that you have. We're going to teach your dollar to do more than one thing at a time. And we're going to teach you how to recycle those dollars so that you can use the same dollar over and over and over again. And I'll give you some examples of how that works. But this is the power of understanding capitalization. And it changes one thing about how money flows through your economy, but the impact is phenomenal. And I want you to see that. So what we use to create your bank, and there are different tools that you can use based on what's available to you, but what we use is a system called infinite banking. Now, there's a lot of information out there on infinite banking. One of the infinite banking Bibles is a book by a man named Nelson Nash, and it's called Becoming Your Own Banker. There's other books out there, and there's people that do this in different ways. What I'm going to share with you is the way that infinite banking should be done to give you the greatest impact, not the greatest promises, the greatest guaranteed impact. So we take these policies, and again, all life insurance policies are not created equal. So when we build these policies, we engineer them specifically, one, for economic efficiency. We want to increase the efficiency of every dollar that comes into your world. We're not building these policies for death benefit, even though there is a death benefit, but it's called life insurance. And so what you're going to learn is the living benefits of life insurance and how to use it as your own bank. Now, again, this is not a new concept. You can go look and see that this is what Walt Disney used to build Disneyland in Florida. This is what Ray Kroc used to start McDonald's and hire his new mascot, Ronald McDonald, and market that. You could go look at our current president's financial disclosure when he ran for office and that he submitted in 2019. And you'll see that he has 4 policies just like the ones that I'm describing to you now. The wealthy have always understood this, and they've always used it because they understand the power of the compounding interest, and they understand and they have protected the taxes. So this money doesn't just grow tax deferred. You will never pay taxes on the growth. So with the infinite banking strategy, the first thing you're doing is you're actually insuring your income. Nobody ever told us to do that. Insure your home, insure your car, insure your health, all of these things. What about your income? That's really one of the most important things that you need to insure. So when we use this capitalization strategy, initially, the first thing we're doing is we're insuring our income. And now you have guaranteed contractual growth that is compounding inside of your bank. And when I say guaranteed, it's guaranteed. It cannot, it will not fail. This is a contract that you have with the carrier. And so you're going to have guaranteed compounding interest. And the guarantees are the most important part of this when we put it together. And you have liquidity, not your money, because you will never pull any of your money out of your bank. But based on how much you have in your bank, you have the liquidity to use other people's money, again, dollar for dollar, to pay for living expenses, to make your investments, to do your consumption, to build your retirement strategies, to purchase real estate. All of these things are available to you, whatever it is that you want to do, based on the liquidity that you have in your banking policy by collateralization. And here's the thing, when you want to take this money out, there's no qualification. No one's going to check your credit score. No one's going to ask you, when are you going to repay or how are you going to repay? Because again, you are the bank. You don't just have the policy, you become the bank now. And we're going to show you that you can pay the loans back interest only. You could not pay them back. You can pay them back on whatever schedule you choose. And as a wealth strategist, we're going to help guide you through that process. So you know the economic benefit of whether you want to pay more money, pay loans off, or whether you want to just add more money to your bank. And we'll show you the numbers and what is the best economic decision for you. Also, people who use these strategies, we see them able to pay off their third party interest, pay off their debt in about a third the time and save an astronomical amount of interest that they would have been paying. Remember, the second part of that Albert Einstein quote is that those who don't understand compounding interest pay it. And that's what we see a lot of people doing. And we can put an end to that, help you put an end to that using these strategies. So we're going to build your bank. We're going to show you how using this capitalization strategy, now your bank becomes the most important part of your economy. So here's something that's a little humorous, but it's factual. So I told you that I was a Marine. I joined the Marine Corps in 1988. I was 18 years old, and I was signed up to be a killer. A few years later, I found myself, off in Saudi Arabia and in Desert Storm and Desert Shield. But before any of that happened, that first year that I was in the Marine Corps, insurance agent comes by, talks to me about buying life insurance. I thought, hey, that's a good idea. Never going to need it because I'm a Marine and I'm going to live forever and I'm invincible because I got an S on my chest. But I'll go ahead and buy some insurance. Not putting a whole lot of money into it, $6,300 a year. And so this was back in 1988. You see almost $400,000 in death benefit. But he did tell me something. He didn't educate me on the policy the way that I'm educating you now. I didn't know the things that I know now. But he did tell me, as you continue to pay your premiums, it's going to build up some cash value. And as it builds up cash value, let's say, you need new tires for your truck or something, you can take out a loan against your cash value, and then you can use that money to do the things that you need to do. I'm like, oh, okay, well, that's cool. Well, again, I, have the payments coming out automatically. I'm not even thinking about it. And, I go off to war, I come back, I get married, I start having children. And then the opportunity to need to borrow cash from my policy then comes fast and furious, right? And so, I borrowed, a couple of $100 here, I borrowed $1,000 there. But because the policy really didn't have any relevance to me, there was nothing that, that really made sense. It was just an expense that I was sending out there. When I got to the point where I need a little bit more money, I just pulled it all out. I lapsed the policy and, just went on with the rest of life. Here's what I didn't know. I didn't know what this policy would do for me in the future. Now, so that first top part of that slide, nothing's sexy, nothing's amazing there. You just see the death benefit going up. You see the cash value going up. But let's drop down to that bottom slide and that yellow block. And I haven't changed this. I made this slide last year, but so now we're in year 35. I'm 52 years old today. So that would mean this policy is 35 years old. And here's where I want to show you the power of compounding interest. Now, remember, I started in 1988. What I want you to understand is that the dollars that I put in 1988 have now been compounding for 35 years. The dollars that I put in 1989 have been compounding for 34 years, and so on. I know you get it, right? But because of that compounding interest, look at what happens. In year 35, I'm 52, I only put $1,500 into the policy. Now, if you, and you see that's the third column, $1,500, that's how much I'm paying. Now, if you go all the way to the right, you see the death benefit is now $855,000. And if you come back left one column, you see this number, $13,050. Do you know what that number is? That is the amount of cash that shows up in my policy this year when I put in $1,500. So I put in $1,500 and I got credited $13,050 into the cash value of my policy. You can check my math by looking at that number, 294,512. If you subtract 281,462, the number above it, if you subtract that from 294, you're going to get $13,050. So if you hand me $1,500 and I hand you $13,050, how many times do you want to do that? You're going to do that as many times as you can, or until I stop giving you $13,000. This is the power of compounding interest at 35 years. This is what is called a wealth engine. There's a point where you put in $1, you get $1.07. There's a point where you put in $1, you get $2. There's a point where you put in $1, you get $3. This is amazing. We're at the point here where I put in $1,500 and I get $13,000 out. That's the power of compounding interest. And that's the tool that is inside of the life insurance policy that I had, but I did not understand the power of it. This is the bank that we're going to help you build. Okay, now we're going to move to the second part of Vortex Banking. Now, many of you may be familiar with different types of trust. There's lots of trusts, but I'm going to explain to you a trust, and we're going to send you some information after this. I'm going to explain to you a trust that is somewhat unique. This trust was actually created 489 years ago. It was actually started in England, and the sole purpose of the trust when it was created was to stop King Edward from doing land grabs and taking people's land just because he could, similar to what we call eminent domain here in our country today. And so the founding fathers, when they came over, they brought this trust with them. And they actually even wrote into the Constitution the provisions to protect and allow this trust to operate. You can find that in Article 1, Section 10, and you'll see that we have the right to contract with one another, and the government shall not infringe upon that right. And so this trust, it has 5 pillars that it stands on. It is a non-grantor, irrevocable, complex, discretionary spendthrift trust. Now, all 5 of those characteristics coming together and the language that is used in this particular trust make it a little bit different from the garden variety of trust that you may go get from your attorney or your CPA. This trust is a constitutional law trust only. It is not a legislative trust, meaning it was not created by our legislature. It cannot be legislated against, and our legislature cannot change the abilities of this trust or add or take things away from it. And we know that because it's been to court many times. It's been all the way to the Supreme Court 2 times. And in the last time that it was in the Supreme Court, the justice said that this trust is not subject to the myriad of changes that may be imposed by our legislature regarding other trusts. So this trust has been around for a long time, longer than our country. And this trust is being used by people that we all know their names. And I'm going to show you some of the examples of how people use these trusts and what they're able to do. So because this is not a legislative trust, it's not a creation of the legislature, it's a constitutional law trust only, it is applicable in all 50 states. It's never registered in any specific state once a person has the trust, but it is federally recognized. And so that takes care of everything you need. This trust, since it cannot be litigated against, anything that this trust owns, anything that's in the corpus, the body of this trust, cannot be litigated against. When you sell your house to this trust, when you put your money in this trust, when you take your business assets, you put it in this trust, someone can sue you and get a judgment all day long. They can get a judgment for $40 million. And you know what you do? You stand there in court, you pull out your pockets and say, hey, I'd be glad to give you that $40 million, but I don't own anything. Well, we're going to take your house, sir. I don't own a house. My trust owns a house. Well, we're going to take your business assets and revenue. I don't have any business assets. I lease my business assets from a trust, and that trust cannot be litigated. It's not subject to any turnover orders. A judge couldn't even subpoena the assets of your trust. The only way that your trust could ever be penetrated is if it was set up fraudulently, if there was fraudulent conveyance where you put something in the trust, but you didn't tell the truth. For example, if you were pending a lawsuit, or if you're in the middle of a divorce, and then you establish this trust and you put your assets in the trust, and then you say, well, they can't be attached. Well, they're going to say, hey, we're looking at the data when the trust was established, litigation was already in place, the trust, that was a fraudulent conveyance. And so we're going to penetrate the trust. That's the only case where that could happen. So now you have this trust, you have 100% asset protection in all states. What else do you have? This trust cannot be taxed. So what that means is, since the legislature didn't create it, they can't tax it. They tax you and I because they give us a social security number, and they make us a business when they do that. We're actually considered a business entity. That's why our name is in all caps on all the government documents. You can look that up. And so they see us as a business, they can tax us. Everything else they can tax if they create or license or allow. They can't tax this trust. So that becomes really powerful, because now this trust is able to do some other things. It is able to permanently defer all capital gains tax for anything that it owns inside the trust. Capital gains tax. For those of you that are in digital currencies, cryptocurrencies, you don't even have to liquidate your digital currencies to have a capital gains situation. You could buy from one currency to another. You can do a transfer. All of the things that you could do that would trigger a capital gains event, a taxable event, if your digital currency, if your crypto, if your wallet is inside of this trust, you can permanently defer all of those capital gains. And now they'll be recognized. They'll be on the 1041 tax form that's filed in the name of the trust, and then they will be deferred permanently because the trust owns them, and the trust is benefiting from that for the sake of the beneficiaries of your trust. But because this trust is discretionary and irrevocable and non-grantor, you as the trustee or whoever you appoint have complete control over all of the assets, over all of the capital inside of the trust. Nelson Rockefeller said the key to success is to own nothing, but control everything. Own nothing, but control everything. So if you don't own your digital currency, if you don't own your NFTs, if you don't own your home, if you don't own the income that comes in through your business, if it's all owned by the trust, you control it, but you can't be litigated. You can't be sued against it. Two of the biggest things that attack the wealth that we create, or that we try to create, are taxes and litigation. And so with this trust alone, we're able to mitigate litigation 100% and dramatically reduce the tax liability for the assets that we have and the money that we make. Our lead accountant has been doing this for 31 years with this one trust. His average reduction over 31 years, 10,000 tax returns without one single audit, his average reduction in tax liability is 84%. Think about what you're paying in taxes in your business, in your personal life. Think about what you're paying in taxes. And instead of that being 100% taxable, think about only paying taxes on 16% of it. And again, that's not a small sample size. That's 31 years and over 10,000 tax returns. Richard, he's our lead accountant. I believe he's one of the foremost authorities in this nation on the trust, and he knows the tax code, IRS code 643B, which allows us to do the things that I'm telling you about. He knows it inside and out. He's seen just about everything that you can see, and he's a tremendous asset to our trust clients, because not only is he the accountant who's worked with these trusts, But when someone purchases a trust, he's going to be your accountant, managing your trust, making sure that it's set up properly, that your assets are put into the trust properly, and filing your taxes for the first 12 months. And that's included in the purchase of the trust. And so we're going to make sure that you're set up. If you have an accountant that you're already working with, or you are an accountant, guess what? He will train your accountant over those 12 months so that after that, they know how to file the taxes and where things go, all of that accounting stuff that I don't even want to think about, but he'll train your accountant if that's someone you want to stay with, or you can stay with him. And it's like $2,000 a year for him to continue to manage your trust and file your taxes. So this trust is amazing. So now you've got the ability to defer capital gains, defer passive income tax, defer royalties, anything like that. You can defer the taxes on that permanently. You've got 100% asset protection, and life is really changing once you have this type of trust. So let me give you a quick example here. This is a current client from 2021. And he's a business owner, and you can see here on this tax worksheet, and we could do one of these for you. You could give us your taxes, and we could put it in here and show you exactly the impact that it would have for you. But so he has $1.1 million in revenue. You can see that right there. That's his gross receipts. Then we see some business expenses. He pays himself $170,000 and some change, W-2 from his business. He's got a little interest that he's earned, some dividends that he's earned, but he's also got $218,000 in rental income from properties that he owns. So based on that, those numbers and his deductions, his taxable income for 2021 is $687,932. And being in the tax bracket that he's in, his tax bill for 2021, down here at the bottom, is $193,913.84. Okay, almost $194,000, and he grossed 1.1 million in his business. So that's a nice little chunk of money that he's paying to the IRS. Cost of doing business, right? Well, not necessarily. Now, because of the structure that he has and because of his business, he requires a trust that I've been explaining to you, and also our business trust that allows you to do a pass-through. But let me show you how powerful this is. Now, based on all these same numbers, he's got, 1.1 million, he's paying himself 170,000, and that's W-2 income. And so now, because he has these trusts, and because the passive income goes right into the beneficial trust and taxes on that are deferred, you see this thing here, it says equipment and service lease, 70% NI. Here's an amazing thing for our business owners. Now, I told you that we transfer our personal assets to the trust. We also put our business assets in the trust. We also take all of our intellectual property for our business and we place that in the trust, and we value all of those things. Now, your business still needs to run, but it doesn't have any assets. It doesn't have the stapler, the desk, the trucks, everything that your business formerly owned, the trust now owns. And so what we do from there is we do a lease back of all of those assets. So now your business is making a lease payment to the trust for the use of everything it takes to run the business. Now, typically we see that lease about 70% of net income. Now, we've seen it higher. I've seen it all the way up to 94%. But let's just say it's 70 like it is in this example here. Here's what that means. Now, 70% of net income is not taxable because it's a lease payment. 70% of your income is not taxable because it's a lease payment. So now you start your normal deductions on the 30% above that. And let me show you how powerful that is. And I won't go through all the tax stuff here, but again, if you want to go through that in detail or have us do this for you specifically, we can show you exactly how it would work. But here's what happens. Now, his taxable income goes from $687,932,000 to $136,044.30. His income tax that he paid this year in 2022 for 2021's taxes is $21,808.75. He saved in taxes over $170,000. And the reason why I love that money is because that's almost exactly what he paid himself in W-2. So as a business owner, what does that mean? I could replace myself and go do something else. Or I could hire two people at half my salary to do marketing and to do sales and increase and grow my business. Or I could hire four people, whatever I want to do, because all of that money goes straight to the bottom line. Every dime I save in a business is 100% profit. So he has a profit of $170,000 just on his taxes because of the trust strategy. And that's just in 1 year. That's how powerful this is. Now, who's doing this? How does this work? Well, here's something that I like to share here. This is, and it's a little bit funny, but it's true. You may have seen these articles. You may have seen the first one, you may have seen on the news because they made a big deal out of it. You remember 2020, the pandemic year, and people were getting stimulus checks. Well, at least 18 billionaires in the United States of America. I don't know how many millionaires, I don't know how many multimillionaires, but at least 18 billionaires received the stimulus checks due to tax deductions. What does that mean? I'm a billionaire and my taxable income, if I'm married, is less than $140,000. If I'm not married, it's less than $70,000. How is that possible? Well, they know something we don't know, right? Let's look down at the second one. This one's even more fun. Make it big for you there. So here we have four names that we all know: Warren Buffett, Jeff Bezos, Michael Bloomberg, and Elon Musk. And this article came out in ProPublica last year as well. And what we're looking at here is the amount of money that they earned over a 4-year period from 2014 to 2018. And then we're looking at their true tax rate on the money that they earned. Warren Buffett in that time, his wealth grew by $24.3 billion with a B. His true tax rate is 0.1%. Now, he's famous for saying that his secretary pays a higher percentage in taxes than he does. But his true tax rate is 0.1%, and he made $24 billion during that time. Now, does that previous slide start to make some sense now? Does it start to kind of connect a little bit more? Jeff Bezos made $99 billion with a B in those 4 years. And he paid 0.98% taxes. 0.98, that was his true tax rate. And we know Amazon didn't pay any taxes either. So he didn't pay any, hardly, well, he paid some, and there's a number there, but the percentage is so low that this is how the rich get richer, right? This is how wealth engines work. Michael Bloomberg earned $22.5 billion, true tax rate of 1.3%. Elon Musk, $13.9 billion. His true tax rate was 3.27. It's not about how much you make, it's how much you keep, and how much you keep working for you in your capitalization strategies, and how much you're not giving away in taxes. I believe in paying taxes, but not 1 cent more than you have to. This is going on every day. I told you, none of these things are new. None of them are revolutionary. We're just bringing this information to people who have not typically understood it because of the way we've been educated to operate our finances. But now when we combine these two things, some amazing stuff happens. So we take the trust and we take the infinite banking and we put them together. We actually put your banking policy inside of your trust. And let me tell you why we do this. because in the past, there were kind of no restrictions on these life insurance policies. Mafia was great at it. They would take out policies on everybody in their family, right? Fat Tony, Guido, whoever, and they would make their money through their endeavors, and then they would shove cash into their banking policies. 50,000, 100,000, $1 million into these policies they have on all their family members. And so then they would take that money out to go do other things. But now the money is what? Laundered because it came from the insurance company. So supposedly it's clean now. But also back then they were getting like double-digit returns on this money in these whole life insurance policies. Well, after enough of that, insurance companies, insurance industry they lobbied and they said, hey, these guys are not using these policies for insurance. And so they came up with this rule. It's called a modified endowment contract. And, we call it a MEC in the business, but it's a modified endowment contract. And what that means is if you have so much cash in your banking part of your policy relative to the death benefit, if you go over a certain threshold, then now it's considered a modified endowment contract, and that money becomes taxable. So when I was building infinite banking policies 10 years ago, we were always trying to get our clients as close to the MEC as possible, but not cross that line. If you cross that line, if you get too much cash in there, you get a letter from the insurance companies that says this is now a modified endowment contract. You have 30 days, 45 days, whatever, to take the money out. If you do not, all of the money in your cash over the premium that you paid is taxable this year. So we have clients that have hundreds of thousands of dollars in their cash value of their policy. They don't want to pay taxes on that money, especially all of it in 1 year. And so we always try to keep them below that MEC line. Now, here's what happens. When we take this infinite banking policy and we put it inside the trust, where your digital currency is, where your assets are, where your home, your furniture, your cars, your shoe collection, everything's inside of the trust. You don't own anything, but you control everything. We put your infinite banking policy inside of the trust as well. Now, when we MEC that policy, when we cross that threshold, the insurance company sends a letter that says, this is now a modified endowment contract and all of this money is taxable. And it sends it to the name of the trust that owns the policy. Well, that modified endowment contract, those taxes are capital gains tax. So then your trust acknowledges the capital gains tax for that modified endowment contract and permanently defers those taxes. So now we can go back to supercharging these policies and creating an extreme amount of efficiency for the dollars that are coming into your world based on it being inside of the trust. This is why we call it Vortex Banking, because now your money goes in, it never comes out. You're not paying any more than 1 penny than you have to pay in taxes. And your infinite banking policy is just cranking and cranking and cranking with that compounding interest. And your trust is keeping you protected from litigation and excess taxes. And this is how you start to look like the people on that previous slide. This is how it works. This is Vortex Banking. So